Hey guys, welcome back to Stacking Stocks, and thanks for joining us today. So, Nio and other EV stocks in China recently got hit extra hard. What could be the underlying factors behind the crushing of Chinese EV stocks? Let's find out. Nio stock has responded favorably to the company's fundamental growth in SUV deliveries recently, posting huge gains as investors flood into the space. However, a new threat has emerged that could potentially jeopardize shareholders' ability to buy and sell Nio stock on the New York Stock Exchange. We'll take a look at recent regulations that could lead to Nio stock getting delisted from the New York Stock Exchange and create big hassles for those who want to participate in the Chinese company's future growth. As much as the figures could be favorable, you also need to know the risk factors involved. On a day when the NASDAQ index is down more than 2%, it shouldn't be surprising that aggressive growth names in the EV sector are leading the way. But Chinese EV makers Nio, XPeng, and Li Auto recently got a double whammy, which explains why the declines are as high as they are. So, what are the factors behind the decline? In addition to market sentiment going against high growth, speculative companies such as these, Chinese stocks in general are in the crosshairs. That comes after the ride hailing company DD Global announced it was delisting from the New York Stock Exchange under pressure from the Chinese government. But investors who look past the broader headlines will also see these three companies have recently reported good progress in their growth stories. Despite the recent macro factors impacting the share prices of Nio, XPeng, and Li Auto, each company reported strong growth in its latest delivery update. Nio shipped a record 10,878 vehicles in November, bringing its year-to-date total to almost 81,000. That represents an increase of 120.4% over the prior year period. But that pales in comparison to XPeng's 285% increase year over year so far in 2021. And like Nio, Li also reported record November deliveries of almost 13,500. However, the significant increase in delivery numbers does not compensate for the fact that investors are unsure whether Nio's ADR shares will be available for trading next year, or for that matter, next month. Nio's ADR shares are currently trading at a 12 times sales multiple. If investors could be sure they owned what they think they own, the multiple might be justified. However, given the risks, investors would not be comfortable paying even half of this sales multiple if Nio increased the 2021 third quarter deliveries at twice the current rate. While these EV makers are navigating global supply chain constraints well so far, they're not immune to investors' fears related to the pandemic and Chinese regulators. Uncertainties over the Omicron variant and what impacts it might have on global economic recovery have investors taking a risk-off approach in general. And Didi's announcement adds fuel to the fire for shares of Chinese companies traded in the U.S. So we believe that's why there are rumors about delisting Nio. What are those rumors? Investors in Nio face a major risk of ADR delisting Nio. According to reports, the Chinese Communist Party is pressuring Chinese enterprises to leave foreign exchanges and discourages them from registering ADR shares on foreign exchanges. A delisting would be a major setback for electric vehicle investors in the United States. Nio's ADR risk has just skyrocketed. So far, electric vehicle companies in China have remained under the radar and haven't been subjected to regulation by the CCP, China's ruling party. Whatever the CCP wants from Chinese firms, it usually gets. Its authority is rarely questioned, and the CCP isn't afraid to use the government's long arm to impose its vision for the future on Chinese companies. Unlike Alibaba, JD.com, or DD Global, Nio and its peers in the electric vehicle industry have escaped greater scrutiny and regulation. However, Chinese electric vehicle manufacturers may find themselves in hot water with the Chinese Communist Party. The CCP is approaching companies that have ADR shares listed on foreign stock exchanges, and Nio is one of them. The CCP is said to put more pressure on Chinese companies that are deemed to be too patriotic. DD Global, a ride-sharing service with massive operations in China, was in trouble with the CCP this year for national security reasons. Only a week after DD Global listed its ADR shares in the United States, Chinese authorities ordered DD's app to be removed from the Chinese App Store. The official reason given was that DD had violated data laws. DD's data collection practices were deemed illegal by China's Cyberspace Administration. Recently, we established that the same agency, the Cyberspace Administration of China, had asked management to take steps to delist the company's ADR shares in the United States. This might not have been Didi's first choice, but companies in China rarely have any choice but to comply when the CCP calls and demands something. The Chinese Communist Party, which has never been a fan of foreign disclosure rules, could easily ramp up its campaign and pressure all Chinese companies to delist their ADR shares, with disastrous consequences for investors who believed in the long-term potential of, in our case, electric vehicle maker Nio. The risk of delisting has risen significantly in recent days, and coercing Chinese companies to give up their overseas listings is exactly what you would expect from the CCP. The move on Didi is a bad omen for other companies with ADR shares. Nio is just one of the many companies that could be affected by the CCP's long-term goal of making foreign stock listings of Chinese companies illegal. In the event of a delisting announcement, Nio's ADR shares are likely to drop significantly as investors try to liquidate their holdings. The key point to grasp here is that Chinese companies themselves request that their ADR shares be delisted and trading be halted in order to appease the CCP. This is not a result of enforcement actions taken by U.S. regulators. The recent events in China are both alarming and vexing. The ADR risk is a significant risk that raises fundamental questions, such as how certain are you as an investor in an electric vehicle company that you actually own a stake in? Unfortunately, there's no certainty in the answer. The CCP could arrive at any time of the week and declare that the time for Chinese companies to use ADR is over. Well, what happens next? Having shares delisted from the New York Stock Exchange would be a serious blow for Nio shareholders. Many U.S. investors would be in a position in which they'd have to decide whether to sell before the delisting took effect or hold on to their stock. They'd still have an ownership interest in Nio, but they wouldn't easily be able to sell their shares or buy more stock within a U.S. listing. That explains why shares have been on a declining trajectory. However, investors looking at the company level might also find the share declines to be an opportunity. XPeng launched its new P5 smart sedan in September. It delivered 2,154 P5 vehicles in November and said it maintains a solid order backlog of the new offering. XPeng also launched a new smart SUV in July 2021, and the company delivered more than 5,500 of the G3i in November. Li aims for a different niche than both Nio and XPeng. It sold the Li 1 SUV that contains a small gasoline engine that helps provide an added range with the ability to recharge its batteries. Demand in China continues to grow, and Nio has already launched in Europe with shipments to Norway beginning last summer. The company plans to continue expanding in the large European EV market next year, too. While the macro environment is going against these specific names right now, long-term investors might find it's a good time to buy as the businesses continue to perform. As long as Nio can execute well on its business model, shareholders can afford to wait and see what happens. Let us know what you think via the comments section. We'll keep monitoring the situation on your behalf, and we'll be back with more informative news. Thanks for tuning in today. Remember to like, share, and subscribe, and we'll see you next time right here on Stacking Stocks.